Today, we're talking about what's the same and different between an index fund, a mutual fund, and ETFs. These three terms are often used interchangeably, but there is a difference. I've worked with too many individual investors who I wish had watched a video like this, so they would know the differences between these three funds and would in turn have saved them a lot of heartache and a lot of money in fees. I'll talk about the differences between these three funds, give you examples of the largest funds in each of these categories, as well as helping you learn which is the best option for you to choose in your own investment portfolio. Welcome back to my channel. 大家好, it's Jason Ko here. I'm a certified financial planner with over a decade of experience and fluency in Cantonese and Mandarin. Now, before we get started, I am a financial advisor, but I am not your financial advisor. So keep in mind that this is educational in nature and not meant to be financial advice. And when I do talk about specific products and its past returns, it is not a financial recommendation nor an indication of future performance. With that out of the way, let's talk about what these three funds have in common. The biggest similarity of these funds is that by doing one transaction, you're able to own a small percentage of all its underlying assets. So let's imagine you have a friend and that friend likes chocolate, but you don't know which kind of chocolate that person likes. So which of these two bags should you buy? Buying the one with one type of chocolate is a gamble because either your friend loves it all or hates it all. Buying the mixed bag is a safer investment because your friend will probably love some and will ignore the ones they dislike. Your friend won't eat as much of the kind that they like, but you also avoid the catastrophic outcome of your friend actually having a peanut allergy and you're only giving them a bag full of Reese's peanut butter. Buying individual stocks like Microsoft, Apple, or Boeing is like buying a bag with one kind of chocolate. You can either gain a lot or lose a lot. But if you buy the right fund, you can own not just Microsoft, Apple, or Tesla, but thousands of other stocks with the same amount of money. Now, you won't triple your money in a year like buying NVIDIA in 2023, but you also avoid the catastrophic outcome of losing all your money, like buying Moderna stock at the peak of 2021 and then losing 75% of your money. When you buy a mutual fund, index fund, or ETF, you're buying the bag with all the different types of chocolate. The advantage of doing this is number one, it's really convenient. And number two, it offers you a lot of diversification. With one transaction, you own a small percent of everything that the stock market has to offer. Before we talk about the differences, I have a favor to ask. I'm on a mission to help Asian Americans and Chinese-speaking immigrants to achieve financial independence and peace. So if you believe in that mission as well, hitting the like button is an easy way to help. In order to understand the differences between these three funds, we're going to need a square. Mutual funds and ETF, which is called exchange traded fund, are two types of different funds. Mutual funds were created in 1924, and ETFs were created in 1990. From that alone, you can see that ETFs are a newer creation. Index fund is a type of fund that invests in an investment index, like the S&P 500, Dow Jones Industrial Index, and NASDAQ. You can think of an index like a category of investment. The S&P 500 is representative of the largest 500 most profitable and publicly traded stocks. The S&P 600 is similar but focuses on smaller companies. An index fund can be either a mutual fund or an ETF. Index funds are commonly also called passively managed investments. It's called passive because it just buys all of the stocks of an index. Now, on the other end of the spectrum, there is actively managed mutual funds, which means a team of managers are buying and choosing their best investment ideas and putting it all into one fund. Now, in this square, you can see there are actually four different types of funds. You have the passively managed index mutual fund, the passively managed ETF, the actively managed mutual fund, and the actively managed ETF. And later on, I'll give you real examples of each type of mutual funds, so stick around for that. Hopefully this is a little easier to see. Now that we understand index fund can be structured either as a mutual fund or an ETF, let's dive into the key differences between these two different types of funds. So the first main difference is how they are being bought and sold. With a mutual fund, you can only buy and sell shares at the end of each day, and the price you pay and receive is based on the fund's net asset value, which is calculated at the end of each day. You are also trading directly with the mutual fund company and not another individual investor. And in contrast, ETF shares trade throughout the day on the same stock exchange as individual stocks. The price of an ETF share will fluctuate during the trading day as shares are bought and sold on the exchange. Because ETF shares are bought and sold on the exchange at a market price, the share price may trade at a premium or discount relative to the net asset value, called NAV. Now, if there are more buyers than sellers, then ETFs can trade at a premium to the NAV. And if there are more sellers than buyers, the ETF will trade at a discount. Mutual fund shares will always trade at NAV, and for ETFs, they do not. So you don't have to worry about premiums or discounts for a mutual fund. But for popular ETFs, premium and discounts really is very small, so it's not that big of a problem for most investors. Because ETFs are traded like stocks, if you use a commission-free broker, then you can avoid paying any cost to invest into an ETF. For mutual funds, you trade directly with a mutual fund company. For mutual fund, you can typically only avoid a trading commission if you are dealing directly with the fund company. For example, if you bought a Fidelity fund through your Fidelity account or a Vanguard fund through your Vanguard account, it is commission-free. But if you bought a Fidelity fund at your Vanguard account or a Vanguard fund at your Fidelity account, there is a cost to buy, usually around $10 to $25. ETFs also make it easier to rebalance a portfolio because you don't have to wait until the next day to finish your rebalance. You can log in once, sell the ETFs that's become too big of a portion of the investment pie, and you can immediately have the cash to buy another ETF. With mutual funds, you have to first put in the order on the day and then wait overnight to trade with the mutual fund company, and then have the cash the next day, next business day, to put in your buy order, and then you have to wait overnight again for the buying to occur. This difference in trading also leads to the second and more important difference, which is ETFs are more tax efficient than mutual funds. When you sell your shares to a mutual fund company, you are asking the mutual fund company to pay you the money. And what the mutual fund company needs to do is to sell the money, sell the stocks from the fund to pay you. And that can trigger a capital gains that is passed on to the remaining investors of that mutual fund. Now, with an ETF, when you are selling or buying an ETF, you're dealing with directly another investor. And so the mutual fund company that's running the ETF doesn't need to raise any money because the money is transferred directly from individual to individual or institution to institution. And the person selling you the capital gains has the tax bill because he's the one who sold potentially at a capital gain or capital loss. The third key difference is cost of ownership. ETFs often have lower expense ratios than mutual funds. This is because the ETF structure allows for lower operational expenses. With mutual fund, the company is responsible for all of the bookkeeping, all of the management, and handling all of the buy and sell orders and sending out statements. And with an ETF, the company doesn't have to do that because the ETF shares are bought and sold on an exchange between investors. So they don't have to handle any of the trading order. They don't have to have the operational bloat. The company just needs to manage the underlying basket of securities. This operational efficiency allows ETFs to charge a lower expense ratio than comparable mutual funds. So if a company has the same strategy between a mutual fund and an ETF, the ETF format will likely have a lower cost. Due to the lower cost of ownership of an ETF from lower expense ratio, lower tax bill, and commission-free trading, ETFs have a lot of advantages over mutual funds. Now that we've covered the differences between the structure of mutual fund and ETFs, let's move on to the other key distinction, the difference between passively managed and actively managed funds. So as we discussed earlier, passively managed funds simply invest in the index. So let's say this pie is the entire investable universe, like the S&P 500. If the S&P 500 grew 10%, then the index fund following the index will grow by 10% minus any fund fees. And it's just like buying the entire bag of mixed chocolate. Now, in contrast, the actively managed mutual fund employs professional portfolio managers who are trying to outperform market by selecting different pockets of the investment universe that they believe will perform well. It's like taking the bag of mixed chocolate and then keeping out what you like the Reese's Peanut Butter and York and Almond Joy, and removing the ones you don't like the Hershey's and the Kit Kat. It is important to note that the distinction between passive and active management is more of a spectrum than a binary choice. Unlike the clear-cut difference between a mutual fund and an ETF, The fund can fall anywhere along the spectrum, from purely passive to highly active. For example, some funds may start out with an index, but then make small bets along the way, say they cut this out, cut this out, cut this out. It looks very similar, but it has small bets for an attempt to outperform. Others may start out mostly active, and they start out with very high conviction small bets, but then over time, as the fund grows, they take on more investor money, and they have to make bigger and bigger investments. They may start making more investments that start to look more and more like the market. And some funds may be in between, like factor-based or smart beta funds that passively track an index, but that index itself is based on active management ideas. And with that context, let's look at some of the key differences between passive and active funds. So first, let's talk about tax efficiency. In general, passively managed index funds tend to be more tax efficient than actively managed funds. And that is because index funds have lower turnover. They are not constantly buying and selling securities in an attempt to beat the market. An S&P 500 index fund might only sell 2% of the holdings with a 2% turnover ratio each year, meaning that out of the 500 stocks, 490 are held long-term each year, which means you realize less capital gains. An active fund, on the other hand, tends to have higher turnover as the portfolio managers are attempting to trade the securities more frequently in hopes of outperformance. This can lead to higher capital gains distribution and a bigger tax bill for the shareholders. Of course, if you're investing through a tax advantage account like a 401k or an IRA, this tax efficiency difference doesn't matter. The second key difference is cost. Passively managed index funds are generally much cheaper than actively managed funds. This is because index funds are simpler and cheaper to operate. There's no highly paid fund manager making investment decisions. The average expense ratio for an actively managed equity mutual fund is around 0.5 to 0.75%. Before a passively managed index fund, the expense ratio could be as low as 0, like some Fidelity zero-fee funds, and it lands on an average of 0.12%. Over time, the differences between these fees can end up adding a lot and eat into your returns. And this cost difference is a major reason why passively managed funds have tended to outperform actively managed funds over the long term. Numerous studies have shown that the vast majority of actively managed funds fail to consistently outperform their benchmark indexes after fees. The higher fees often negate any outperformance that the active manager might achieve through security selection. And another factor to consider is transparency. With an index fund, you always know what you're investing in. It's very clear. The fund holdings will match the index, but with an active fund, the manager is making active decisions and the holdings may not always be clear. This lack of transparency can also make it harder to understand what the role of the fund is playing in your overall portfolio. A fund manager may choose to invest in one sector one year, but then choose to invest in another sector the other year, and it's hard to see how it can fit into your investment pie. Before we talk about which one is right for you, let's go through some real-life examples of the largest fund that fit into each of the 4 categories. To keep this video brief, I'll focus on funds that invest in a uniform blend of the largest United States stocks. And keep in mind, again, that this isn't meant to be an investment recommendation. For the active mutual fund, the largest one is American Fund Washington Mutual. The ticker symbol is WSHFX. This fund was created in 1952 and it has $181 billion invested with an expense ratio of 0.64%, which is on the high side. And it has an active ratio of 56 out of 100, meaning it is quite different from an index fund. This is an active fund, so you do see a turnover ratio of 30%, meaning they buy and trade often with the average holding period for each stock is about 3 years and 4 months. It has 185 holdings, so it's decently diversified, although not great. It has a minimum investment of $250, so it is fairly accessible for the average investor. For 2023, it paid out 2.33% of assets as capital gains, which may look like a good thing because you receive money, but it is actually a return of capital that you have to pay extra taxes on, and it's avoidable, so it's bad. As of March 31st, 2024, its 10-year performance was 11.29% annually, meaning a $100 investment grew to $291 over 10 years. Now, for the passively managed mutual fund, the largest one is the Vanguard Total Stock Market Index Fund Admiral Shares, VTSAX. It has $1.59 trillion invested in the fund with an expense ratio of 0.04%, which is some of the lowest cost funds out there. It is considered an index fund, and it has an active ratio of 0. It also tends to buy and hold the stocks since it has to follow the index, and it has a turnover ratio of 2%, meaning there's an average holding period of 50 years. It has 3,727 holdings, so it is extremely diversified and basically buys every single publicly traded stock in the United States stock market. It has a minimum investment of $2,500, so it is not out of reach for most investors, but it is harder to invest in if you just are starting with a few $100s. For 2023, it did not pay anything as capital gains distribution. Now, this is unusual for a mutual fund, but a unique structure of Vanguard's mutual fund is that an ETF is a share class of its mutual fund. So Vanguard mutual funds with an accompanying ETF actually can piggyback off of the tax efficiency of the ETF. As of March 31st, 2024, the 10-year performance was 12.27% after fees, meaning $100 grew to $318 over 10 years. For the active stock ETF, the largest one is the Dimensional US Core Equity 2 ETF. Ticker symbol is DFAC. It has $27 billion invested in the fund with an expense ratio of 0.17%, which is low for an actively managed fund. It has 2,707 holdings with a turnover ratio of 3%, meaning it has an average holding period of 33 years for each stock. For 2023, it has not paid out a capital gains distribution, making it very tax efficient, which is to be expected of it because it is a large and established ETF. Its 10-year performance was 11.04% after fees, meaning $100 grew to $285 over 10 years. The share price is $30, making it fairly accessible for an individual investor to just buy one share. Although it is considered an active fund, it is what I would consider a passively managed active fund. It is more commonly called a smart beta fund or a factor fund because it utilizes a firm and transparent active investment process, but it was developed by academics and it is systematized and it invests in a group of stocks that carries the personality traits that are associated with historical outperformances, like value investing, momentum investing, quality investing, and small cap investing. Because it is systematic in nature and there's no team of researchers making active decisions, it is lower cost relative to a traditionally active fund like the American fund that we saw, and compared to an index fund, it can provide a potentially higher rate of return due to its active systematic bets. This fund hasn't realized its potential in the past decade though, because value investing, which traditionally would avoid investing in expensive technology stocks, has done poorly during the COVID remote work spike and also the recent spike that we saw with AI related stocks. Moving on, for the passively managed stock ETF, the largest one is the SPDR S&P 500 ETF Trust, called SPY. This was the very first ETF to trade on a stock exchange back in 1993, meaning it's been around for more than 30 years. It has $511 billion invested in this fund with an expense ratio of 0.0945%, which is high when Vanguard and iShares both have an S&P 500 ETF with an expense ratio of 0.03%. But SPY can sustain this high fee because it is still the trading vehicle of choice for large institutions because it has the highest trading volume and it can absorb a huge number of orders, a huge number of money at once. It has 503 stocks with a turnover ratio of 2%. For 2023, it has not paid out a capital gains distribution, making it very tax efficient. And for the 10-year performance was 12.85% after fees, meaning $100 grew to $335 over 10 years. So which one is right for you? For most investors, I would not recommend to invest in an actively managed mutual fund because the average cost of these funds are high and they generally don't end up earning their higher fees and historically has underperformed a basic index fund. But we shouldn't throw out the baby with the bathwater, and my preference is for a passively managed active fund like the Dimensional Core US Equity 2 ETF DFAC, because it blends the best of active and passive strategies while bringing the tax efficiency and low cost advantage of an ETF as well. Although it has underperformed the Vanguard index fund by over 1% over the past decade, I still have conviction in the strategy because it invests in a group of diversified stocks with enduring earnings and are trading cheaply and also have a smaller size relative to the mega caps. And this is a philosophy that Warren Buffett also shares. This type of fund would have done a lot better from 2000 to 2003 when the tech bubble burst and the S&P 500 lost 50%, and value stocks actually were doing really well. But it could be another decade of waiting before it outperforms again, so it does require patience. For those investors who do not share the same conviction that I do, I think a basic total stock market index ETF that invests in stocks or bonds is the ideal starting point for most people. A well-managed index fund from Vanguard, iShares, SPDR, or Charles Schwab will only underperform by the fee that it charges, which is very small. And if you stick with an ETF version as well, you can invest in it commission-free at most online brokerage firms like Fidelity and Charles Schwab. And it can be very tax efficient to own over the long term. It's given by the 0% capital gains distribution, and assuming that you hold on to it long term and gain access to the long-term capital gains tax rate. But you can still lose money if you don't invest in it with the right expectation, so make sure to do more research before investing. If you found this video helpful, please remember to like and subscribe to my channel for future videos from me. And again, I answer all comments, so make sure to leave me one below. Thanks for watching. I'd love to hear from you. 再见.